Okay, the next thing that we need to do is to plan our inventory purchases. If we're going to sell things, and if those sales are going to generate cash collections, in order to sell things, we actually have to have those things on hand to sell. And again, just like predicting sales is not an easy task, predicting the amount of inventory to have on hand is not an easy task. Companies spend a lot of time and effort trying to determine how much inventory to hold on hand, how frequently to reorder inventory. These decisions are going to depend on your supply chain and how quickly you can get items, what the cost of getting items shipped into you is. It's also going to depend on your demand and the cost you expect of a customer placing an order that you're not able to fulfill. How damaging is it to your business to have a stock out? So those are all policies and things that we have to decide before we can make our plans. So what is this company's plan with regard to purchasing? Well, we know that the earbuds that we purchase are going to cost $8 per unit. That's given. And that our ending inventory, given all those decisions that we've made about restocking and all that, we've decided that our ending inventory at the end of each month should be 25% of the next month's cost of goods sold. So in other words, whatever we're going to sell next month, we expect to have 25% of that on hand. That helps us decide how much to purchase. So we're going to create our merchandise purchases budget. The first thing that we do when we decide how much to purchase is we have to replace the units that we're selling. And so what I'm going to do is I'm going to recognize that all the units that we sell, we have to purchase for $8 a piece. And so I'm going to calculate the cost of goods sold for each month by taking the number of units that we're going to sell times the purchase price. And this gives us our cost of goods sold. So our baseline to start our merchandise purchases budget is simply replacing the units that we're selling. The next thing that we have to do is we have to have on hand the amount of ending inventory at the end of each month that we want to end with. And again, our company has decided that each month should end with 25% of the next month's cost of goods sold. So what we're going to do is we're going to take 25% and multiply that by the next month going forward. So we want to end April. On April 30th, we want to have 25% of what we're going to sell in May. On May 31st, we want to have 25% of what we're going to sell in June. And on June 30th, we want to have 25% of what we're going to sell in July. Now, as you're looking at your spreadsheet here, you want to make sure that you don't look forward to the next cell if that next quarter, or if the next column is the quarter column instead of the July column. So you just have to make sure your spreadsheet points to the right cell. But we can see that 70,000 is 25% of 280,000, so we've got that right. So what we know is that each month we want to end with a certain amount of inventory, and we also have to replace what we sell. So we put those two together, and we call that our total needs. How much inventory do we need to have on hand during a particular month? Oops. And we can see that during the month of April, for example, we have to have a total of $780,000 worth of inventory on hand. Now, here's the thing. If we're smart enough in April to plan ahead for the beginning of May, we were probably smart enough in March to plan ahead for the beginning of April. So we probably have some beginning inventory on hand at the beginning of April that we don't have to buy in April because it was already there at the end of March. And if we look at our March 31st balance sheet, we can see that $143,000 worth of inventory was already on hand on April 1st that we don't have to buy during April. So our required purchases are the $780,000 we need minus the $143,000. that we're already going to have on hand on April 1st, and so we only have to buy $637,000 worth of inventory. We can do the same thing in May. How much are we going to have on hand at the beginning of May? Well, we can recognize that April 30th, the amount we're ending April with, is going to be the amount that we begin May with. And so we don't have to buy that 208 that we have on hand at the end of April, because we're going to have that at the beginning of May, so we don't have to buy that during May. And so we can simply add, or we can subtract the 208 and say we have to buy 754. Same thing in June. Since we're planning to end May with $130,000 worth of inventory, we don't have to buy that. And so now we can end, or we can purchase during June $460,000 worth of inventory. All right, so far so good. We take each month, we take what we need to buy to replace what's being sold. Then we have to plan ahead for next month's beginning by having ending inventory this month. And then we also want to recognize that last month we planned ahead to this month, and so we can back off what we don't have to buy in a given month because it already exists. All right, so those are our month-by-month columns. Now if we're looking at the quarter's a little bit different. We got a couple things here where the quarter ends up being a little bit different. I'll highlight those in yellow to point those out. If we look at the quarter, during the quarter we're going to sell 240,500 units at $8 a unit. Our total cost of goods sold for the quarter will be $1,924,000. If we want to look at our ending inventory for the quarter, if we're thinking about the quarter column here, we're sort of zooming out, we're losing the month-by-month detail and just looking at the quarter as a whole. If we look at the quarter as a whole, we need to recognize that the end of the quarter is not April 30th plus May 31st plus June 30th, but rather the end of the quarter is simply June 30th. June 30th is both the end of the month and the end of the quarter. So if we're going to end the quarter with $70,000 of inventory, that's our desired ending inventory. And so the total amount that we need during the quarter is the $1,924,000 to replace what we're selling, plus $70,000 of ending inventory. Similarly, what do we begin the quarter with? What's our beginning inventory for the quarter? Well, the quarter begins on April 1st. So what do we have on hand at April 1st? We have the 143. We don't have 143 plus 208 plus 130 at April 1st. We just have 143. So these two beginning and ending inventory numbers don't add across. The 70,000 and the 143, you simply go and identify the appropriate beginning or ending for the quarter, and you don't add those across. In real life, you're not really tempted to make this error, because in real life on April 1st, you have what you have on hand, and you don't have the other 2 months worth of stuff yet. Similarly, at the end of the quarter, you go out and you count what's in your inventory warehouse, and you just count what's there, and you're not going to accidentally count what was there 2 months ago and 1 month ago. So it's one of these things where you're looking at multiple months over time, and you're almost more tempted to make this error in practice, or in hypothetically, than in real life. So we do need to keep those things in mind. But overall, what we're doing is we're taking what we're selling, planning ahead for the next month, and then subtracting what we planned ahead for this month. And what this gives us is required purchases of $1,851,000 for the quarter.